Testing. 1 million, 2 million, 3 million. Seems to be working. I'd like to just say a few words preliminarily, and then the highlight for me will be getting your questions in a few minutes, because I want to talk about what's on your mind. I urge you to throw hard balls. It's more fun for me if you put a little speed on the pitches as they come in. That you can ask about anything except last week's Texas A&M game. That's off limits. We have a couple of men here from SunTrust. I was just up at the Coke meeting, and I sit next to Jimmy Williams there, who ran SunTrust for many years, and he wanted to be sure that I wore this SunTrust shirt down here. I've tried to get sponsorship on the senior golf tour. I haven't had much luck, but now on the Bankers tour, I'm doing a little bit better. And he says I get a percentage of the increase in deposits in Gainesville. So I'll go out for SunTrust, dear old SunTrust. I would like to talk for just 1 minute up to the students about your future when you leave here, because you're going to learn a tremendous amount about investments, and you'll learn enough to do well. You've all got the IQ to do well. You've all got the initiative and energy to do well, or you wouldn't be here. And most of you will succeed in meeting your aspirations. But in determining whether you succeed, there's more to it than intellect and energy. And I'd like to talk for just a second about that. In fact, there was a fellow that Pete Keelan in Omaha used to say that he looked for 3 things in hiring people. Look for integrity, intelligence, and energy. And he said if that person didn't have the first 2, that the latter 2 would kill them. Because if they don't have integrity, you want them dumb and lazy. You don't want them smart and energetic. And I'd really like to talk about that first one, because we know you've got the second 2. And to play along with me in a little game for just a second, in terms of thinking about that question. You've all been here, I guess almost all of your second-year MBAs, and you've gotten to know your classmates. And think for a moment that I granted you the right to buy 10% of one of your classmates for the rest of his or her lifetime. Now, you can't pick one with a rich father. That doesn't count. I mean, you've got to pick somebody who's going to do it on their own merit. And I gave you an hour to think about it. Which one are you going to pick among all your classmates as for the one you want to own 10% of for the rest of their lifetime? Are you going to give them an IQ test? Pick the one with the highest IQ? I doubt it. Are you going to pick the one with the best grades? I doubt it. You're not even going to pick the most energetic one necessarily, or the one that displays the most initiative. But you're going to start looking for qualitative factors in addition to, because everybody's got enough brains there and enough energy. And I would say that if you thought about it for an hour and decided who you're going to place that bet on, you'd probably pick the one who you responded the best to, because the one that was going to have the leadership qualities, the one that was going to be able to get other people to carry out their interests. And that would be the person who was generous and honest and who gave credit to other people even for their own ideas, all kinds of qualities like that. And you could write down those qualities that you admire in this other person, whoever you admire most in the class. And then I would throw in a hooker. I would say, as part of owning 10% of this person, you had to agree to go short 10% of somebody else in the class. That's more fun, isn't it? And you think, well, now who do I want to go short of? And again, you wouldn't pick the person with the lowest IQ, you would start thinking about the person really who turned you off for one reason or another. I mean, they had various qualities, quite apart from their academic achievement, but they had various qualities. In the end, you didn't really want to be around them, and other people didn't want to be around them. And what were the qualities that lead to that? Well, there'd be a whole bunch of things, but it's the person who's egotistical, the person who's greedy, the person who slightly dishonest, cuts corners, all of these qualities. And you could write those down on the right-hand side of the page. And when you look at that, I don't know which one I'm using. Can you hear me okay with this? Fine. Yeah.
You might want to the side.
What do I do with it?
It just came loose.
Oh, it just came loose, okay. You can see why I avoid technology. Chewing gum is about as far as I get. As you looked at those qualities on the left and right-hand side, there's one interesting thing about them. It's not the ability to throw a football 60 yards. It's not the ability to run the 100-yard dash in 9.3. It's not being the best-looking person in the class. They're all qualities that if you really want to have the ones on the left-hand side, you can have them. I mean, they're qualities of behavior, temperament, character that are achievable. They're not forbidden to anybody in this group. And if you look at the qualities on the right-hand side, the ones that you find turn you off in other people, there's not a quality there that you have to have. If you have it, you can get rid of it, and you can get rid of it a lot easier at your age than you can at my age, because most behavior is habitual, and they say the chains of habit are too light to be felt until they're too heavy to be broken. And there's no question about it. I see people with these self-destructive behavior patterns at my age or even 10 or 20 years younger, and they really are entrapped by them. They go around and they do things that turn off other people right and left, and they don't need to be that way, but by a certain point they get so they can hardly change it. But at your age, you can have any habits, any patterns of behavior that you wish. It's simply a question of which you decide, and why not decide the ones that, I mean, if you like, Ben Graham did this, and Ben Franklin did it before him, but Ben Graham in his low teens looked around and he looked at the people he admired, and he said, I want to be admired, so why don't I just behave like them? And he found there was nothing impossible about behaving like them. And similarly, he did the same thing on the reverse side in terms of getting rid of those qualities. So I would suggest that if you write those qualities down and think about them a little while and make them habitual, you will be the one that you want to buy 10% of when you get all through. And the beauty of it is you already own 100%. You're stuck with it, so you might as well be that person as somebody else. Well, that's a short little sermon. So let's get on to what you're interested in. And like I say, you can go all over the lot. So I don't know exactly how we're going to handle this, but let's start with a hand here someplace or other. Where do we go with the first one? Yeah, right here.
Your thoughts about Japan?
My thoughts about Japan? I'm not a macro guy. Now I say to myself, Berkshire Hathaway can borrow money for 10 years at 1% in Japan now. 1%. And I say to myself, gee, I took Graham's class 45 years ago, and I've been working hard at this thing all my life. Maybe I can earn more than 1%, if I really worked hard at it. 1% annually. It doesn't seem impossible, does it? So I wouldn't want to get involved in currency risk, so I'd have to do it in something that was yen denominated. So I have to be in Japanese real estate or a Japanese business or something of the sort, and all I have to do is beat 1%. And that's all the money's going to cost me, and I can get it for 10 years. So far, I haven't found anything. It's kind of interesting. The Japanese companies earn very low returns on equity, and they have a bunch of businesses that earn 4, 5, 6% on equity, and it's very hard to earn a lot as an investor when the business you're in doesn't earn very much money. Now some people do it. In fact, I've got a friend, Walter Schloss, who worked with Graham at the same time I did, and it was the first way I went at stocks, to buy stocks selling way below working capital, very cheap quantitative stocks. I call it the cigar butt approach to investing, is that you walk down the street and you look around for a cigar butt someplace, and you see one, and it's soggy and kind of repulsive, but there's one puff left in it. So you pick it up, and the puff is free. I mean, it's a cigar butt stock. I mean, you get one free puff out of it, and then you throw it away, and you walk down the street and try and find another one. I mean, it's not elegant, but it works. If you're looking for a free puff, it works. Those are low-return businesses. But time is the friend of the wonderful business. It's the enemy of the lousy business. If you're in a lousy business for a long time, you're going to get a lousy result, even if you buy it cheap. If you're in a wonderful business for a long time, even if you pay a little too much going in, you're going to get a wonderful result if you stay in a long time. I find very few wonderful businesses in Japan at present now. They may change the culture in some way so that managements get more stockholder responsive over there and returns are higher. But at the present time, you'll find a very lot of low-return businesses, and that was true even when the Japanese economy was booming. I mean, it's amazing. They had an incredible market without incredible companies. They were incredible in terms of doing a lot of business, but they weren't incredible in terms of the return on equity that they achieved. And that finally caught up with them. So we have so far done nothing there, but as long as money's 1%, I'll keep looking. I mean, yeah.
You were rumored to be one of the rescue buyers of long-term capital. What was the play there? What did you see?
Well, there's a story in the current Fortune magazine, one has Rupert Murdoch's picture on the cover, that tells the whole story of our involvement. It's kind of an interesting story because It's a long story, so I won't go into all the background of it. But I got the really serious call about long-term capital about 4 weeks ago this Friday, whenever it was. It was my granddaughter. I got it in mid-afternoon, and my granddaughter was having her birthday party that evening, and then I was flying that night to Seattle to go on a 12-day trip with Gates to Alaska in a private train, all kinds of things where I was really out of communication. But I got this call on a Friday afternoon saying that things were really getting serious there. I'd had some other calls before that the article gets into a few weeks earlier. I know those people, most of them pretty well. So a lot of them were Solomon when I was there. And the place was imploding, and the Fed was sending people up that weekend. And so between that Friday and the following Wednesday, when the New York Fed, in effect, orchestrated a rescue effort, but without any federal money involved, I was quite active, but I was having this terrible time because we were sailing up through these canyons, which held no interest for me whatsoever, in Alaska. And the captain would say, if we just steer over here, we might see some bears and whales. And I said, steer where you get a good satellite connection, because I want. So it was. In fact, there's a picture, unfortunately, where I've got my Old Faithfuls going off behind me, and I've got my back to it. I'm on the phone, which was the people in the group thought it was kind of funny the way I was working the phone. But we put in a bid on Wednesday morning. By then I was in Bozeman, Montana. And I talked to Bill McDonough, the head of the New York Fed, about 10 o'clock. They were having a meeting of the bankers at 10 o'clock that morning in New York, and I caught him. We actually delivered a message to him. He called me out there in Wyoming a little bit before 10 New York time, and we made a bid. It was because it was being done at a long distance and everything. It was really the outline of a bid, but in the end. It was a bid for $250 million, essentially, for the net assets of. But we would have put in $3.75 billion on top of that, and it would have been $3 billion from Berkshire Hathaway, $700 million from AIG, and $300 million from Goldman Sachs. And we submitted that, but we put a very short time fuse on it, because when you're bidding on $100 billion worth of securities that are moving around, you don't want to leave a fixed price bid out there very long. Plus, we were worried about it getting shopped. In the end, the bankers made the deal, and. But it was an interesting period. The whole long-term capital management, and I hope most of you are familiar with it, but the whole story is really fascinating, because if you take John Merriweather and Eric Rosenfeld, Larry Hillenbrand, Greg Hawkins, Victor Agani, the two Nobel Prize winners, Merton and Scholes, if you take the 16 of them, they probably have as high an average IQ as any 16 people working together in one business in the country, including at Microsoft or wherever you want to name. So there's an incredible amount of intellect in that room. Now you combine that with the fact that those 16 had extensive experience in the field they were operating. I mean, this was not a bunch of guys who had made their money, selling men's clothing and then all of a sudden went into the securities business or anything. They'd had, in aggregate, the 16 had probably had 350 or 400 years of experience doing exactly what they were doing. And then you throw in the third factor, that most of them had virtually all of their very substantial net worths in the business. So they had their own money up, hundreds and hundreds of millions of dollars of their own money up, super high intellect, working in a field they knew, and essentially they went broke. And that, to me, is absolutely fascinating. I mean, if I ever write a book, it's going to be called Why Smart People Do Dumb Things. My partner says it should be autobiographical, but this might be an interesting illustration. And these are perfectly decent guys. I respect them, and they helped me out when I had problems with Solomon, and so they're not bad people at all. But to make money they didn't have and didn't need, they risked what they did have and did need. And that's foolish. That is just plain foolish. It doesn't make any difference what your IQ is. If you risk something that is important to you for something that is unimportant to you, it just does not make any sense. I don't care whether the odds are 100 to 1 that you succeed or 1,000 to 1 that you succeed. If you hand me a gun with 1,000 chambers, 1,000,000 chambers in it, and there's a bullet in one chamber, and you said, put it up your temple, how much do you want to be paid to pull it once?
Here is a key point from Warren Buffett. Warren Buffett emphasizes the importance of integrity, intelligence, and energy in achieving success. He often quotes a former colleague who said that if a person lacks integrity, Their intelligence and energy will make them more dangerous rather than more valuable. For Buffett, integrity is the foundation upon which successful careers and businesses are built. He encourages people to cultivate habits that reflect integrity and to avoid behaviors that are self-destructive or harmful to others. This principle is crucial in both personal development and professional success. Buffett's investment philosophy is rooted in the concept of durable competitive advantage. He looks for businesses that dominate their industries and have a sustainable edge over their competitors. An example he often cites is a custom picture frame company that excels due to its extensive distribution network, ensuring quick delivery. This kind of advantage makes it hard for new entrants to disrupt the market, showcasing Buffett's strategy of investing in resilient businesses with long-term potential. This approach ensures that Berkshire Hathaway's investments generate consistent and reliable returns over time. Philanthropy plays a significant role in Buffett's legacy. He plans to allocate a large portion of his wealth to the Buffett Foundation, which will focus on important but underfunded causes. Buffett admires philanthropists who have supported critical needs where funding is scarce, such as Rockefeller's support for black colleges. He believes that effective philanthropy should address significant societal issues lacking natural constituencies, ensuring that his contributions make a substantial impact. This strategic approach to giving demonstrates Buffett's commitment to using his wealth to create positive change in the world. Buffett also underscores the importance of public education in ensuring equal opportunity. He credits the public school system in Omaha for providing his children with a balanced, comprehensive education. Buffett believes that a strong public education system is essential for maintaining a society that offers equal opportunities to all its citizens. He argues that public schools should provide the same quality of education to both rich and poor, ensuring that every child has the chance to succeed. This commitment to education reflects Buffett's belief in the power of equal opportunity to drive societal progress. Living a life of integrity and simplicity is another core tenet of Buffett's philosophy. Despite his immense wealth, Buffett continues to live in the same house he bought in 1958, demonstrating his belief in the value of stability and community. He values the connections he has built in Omaha and appreciates the sense of belonging and continuity that comes from living in a close-knit community. This grounded approach to life reflects Buffett's belief that true happiness and fulfillment come from relationships and experiences, rather than material wealth. This perspective encourages others to focus on what truly matters in life,